We're live, everybody. Thank you so much for joining me today. It is Thursday, October 19th, 1 p.m. Central. For those joining us live, thank you so much. Make sure you can hear and see us okay on the live stream. For those viewing us on recording, thank you for stopping in. Appreciate you. Okay, so this one's going to be mostly for people that follow Tesla very closely, specifically Tesla investors. We're going to be talking a lot about the the financials of the company, the stock. None of this is going to be financial or investment advice. Do not take anything that I say as anything as for a decision for your own investment or financial decisions. I'm just here discussing what I see in hopes that it's valuable for somebody, but I don't want anybody to take this as financial or investment advice. So there we go. Okay, now we can begin. What a confusing day. Yesterday was weird. I'll be honest. Yesterday was quite weird. For those that are not familiar, that was Tesla's earnings, quarter three earnings for 2023, in a year where Tesla has continued to grow deliveries quite a bit versus 2022, and they're breaking many different records as far as delivery records go, especially in the second quarter of the year. The Model Y is set to become the best-selling car in the world by the end of the year, but there are some definite financial struggles, financial headwinds, let's say, that the company is facing in 2023 and likely into 2024. And it was really highlighted not just by the earnings, which I think were decent. I mean, there was definitely a downtrend, and there's some questions that we should talk through. But the tone of the call, the earnings call that Elon Musk and the executive team went through was one of the most sobering, borderline depressing earnings calls that I've heard from Tesla in a while. And what made it even weirder, it was within the backdrop of this Cybertruck delivery event being announced just minutes before, really an hour or so before the call started. So it's like a weird dichotomy there where something that people have been waiting for a really long time, specifically people that have been following Tesla, they finally get a date. And then by the end of the call, everybody's like, what the hell just happened? So let's go ahead and sit down and talk through what I saw now that I had a chance to sleep on it and collect my thoughts, how I'm thinking about the company, how I'm thinking about the next, say, 12 to 18 months. And without further ado, let's go ahead and get started. So I'll start with the bad. I'll start with the not good. Let's keep it positive today, everybody. Come on. Let's keep it positive. So the not good. The not good is two trends that are not aligned with where the company was guiding at the beginning of the year. Was auto GM gross margin, so how much money the cars are making per quarter for everyone they sell, and also the operating gross margin, so basically how much money the company makes in total once you take everything into account. There's two trends that seem to be going a direction opposite from where the company was guiding at the beginning of the year, and we can talk about why that is potentially. So in the third quarter of last year, Tesla came in at 26.3% auto gross margins if you exclude ZEV credits, which is the clean energy credits that Tesla gets. And if you also exclude leases. And then in the fourth quarter, we started seeing a downtrend. In the first quarter, we got a sort of a warning that said, hey, we might have challenges this year when it comes to margin, but we should expect to rebound somewhere towards the latter half of the year to 20% levels. We don't think we're going to get under it. And then what we're seeing is kind of the opposite. We're seeing a little bit of a drawdown on gross margins, all the way down to 15.7% gross margins if you exclude ZEV credits and leases. And even though Tesla showed that they're lowering the costs of the car, which is obviously great, and we can talk about the implications of that, because of the pressure on pricing, either due to interest rates being higher or the global economic conditions as far as demand for vehicles go, the pricing has come down faster than the cost of the car. And so that's why you're seeing pressures on the margin for the vehicles, which is heavily impacting the operating margin percentage of the company, which was upwards of 17% in the third quarter of 2022. And now it's down to 7.6%, which is less than half of where it was the same time last year. And so these two things, I try not to talk about short-term price movements because I feel like if you're a long-term investor, short-term price movements are a lot more noise than a signal. But just putting my short-term stupid hat on, that's probably why you're seeing this negative 9%. There's just some trends that are happening with the company that I think investors are saying, hey, you probably don't deserve the multiple we've been giving you, so we need to make sure we lower your pricing to reflect the new reality. And in addition to that, the call itself was quite somber, quite very reserved, very putting a lot of caution in the wind, which I think in a way is a good thing. Now let's talk about that specific dynamic for a little bit. I think within the context of the stock price, and this is where in my opinion, there's starting to be a sort of a divergence between Tesla, the company, Tesla, the stock. Forget about what I think about its long-term implications, but it's clear that there's two different sentiments going on. If you look at Tesla's sales versus the competition, if you look at Tesla's sales in regions where they're selling the Model 3 and the Model Y, they are clearly growing and outselling most competitors, and specifically in the United States, they're taking an outsized share versus competition because of how competitive they are from a pricing perspective, which is a direct result of lowering those prices that's also hitting profitability. So Tesla appears to be in a situation now where, from a market perspective, if you just remove the investment thesis completely out of it, it seems like they're doing everything that the customer is looking for a car maker to do, which is lowering price and making cars more affordable for people to jump into. And I think that directly correlates to the fact that Tesla has been able to sell more cars so far this year through Q3 than they did all of last year, right? Without that dynamic, you wouldn't be able to do that. Now, on the flip side, you have the interest rates on top of it as well, going up from basically zero early last year to upwards of 5.5, whatever we're at now, 5.25. I forgot exactly where we're at, but significantly higher year over year, which is going to make it less affordable for people to be able to afford monthly prices for vehicles. Now, I've had Ray and Zach from Car Edge on this channel before, and one of the things I wanted to study with Ray and Zach, and these guys are folks that are super knowledgeable in the overall car market. Ray used to be a car dealer for a really long time, for decades, and he brings a lot of experience to us from the car dealership perspective and how people buy cars. I think on this channel for the longest time, we were sort of sending the signal that says, hey, the majority of car buyers are monthly payment buyers. They are only concerned about how much car they can get for every dollar they spend, and typically they want to get below a certain level, let's say $500 a month, and they want to get as much car as they can get. And what's interesting about this latest call from Tesla is that we're starting to get a lot of that verbiage now from the company that says, hey, all we care about now is affordability. We're going to be super, super focused on lowering the costs. We're going to be super, super focused on ensuring that we can make our cars as affordable as possible for the masses. And because of that, the company is taking a hit from a profitability perspective, which is likely causing the stock reaction that we're seeing right now. So on one side, if you're a buyer, you're probably super psyched that you can finally afford a Tesla if that's a car that you wanted. But on the other side, if you're an investor, and if you follow the story very closely, you know that there's a lot of people saying, but you don't have to lower prices so much. You can just advertise. You can just advertise, just sell it to the people that want to buy it at a higher price. But it seems really, it seems very, very clear that the company is absolutely focused on lowering the price of the vehicles, which I think in the long term, I really do think in the long term, will become a difficult competitive advantage to overcome as manufacturers continue to ramp up their EV plans while facing all the challenges that Tesla has already gone through, right? So if we look at some of the news that came out yesterday or 2 days ago now, GM, or yesterday, one of these, this week, GM announced that they're delaying their pickup truck EVs by another year because they wanted to be smarter about how they want to invest their money on that side of the business. Another way of saying that's not salesy is that, hey, we don't think we can make money on this yet, so we need to push it out because, for whatever reasons, we don't have enough money to pay for the batteries, they're too expensive, we don't think there's a market for it, we need to make the range higher, whatever it is. But there are complexities that those manufacturers are facing. Whereas Tesla, theoretically, is living that right now. This is sort of the environment that they're going through. The other dynamic to also think about is, as Tesla is going through the hardships right now of lowering the price, what's interesting there is that if you compare them to, say, the performance of the rest of the auto market, which if you compare it to last year specifically, the total broader market, the auto market, the sales from the manufacturers to the dealers are up significantly. But that's because of two very big reasons. The first one is that last year we still had COVID supply chain challenges that the manufacturers were going through. And then once they were able to relieve that towards the end of last year, they were able to significantly ramp up the manufacturing capabilities. And they were selling into lots from a dealer's perspective that were completely empty, right? So it does two things. The manufacturer can sell more cars, and then they have a bunch of places to dump their inventory into, right? And if you follow this channel, if you follow other channels, you probably are aware that a lot of these dealerships have quite a bit of inventory for specific brands. It's not every single brand. I think the Japanese brands are performing much better than the rest of the brands, really, because those guys are really focused on affordable cars, which should be a signal that says, hey, people are looking for more cheaper cars. But these automakers can offset or delay what Tesla is potentially facing right now because they have a dealership network that they can offload inventory on. And so if this thesis is correct, sort of like as we're thinking about this pricing dynamic and this profitability dynamic for Tesla, one of the signals that one should look for, in my opinion, is to see if legacy automakers start ringing the same bell that Tesla did on yesterday's call about, hey, we think there is a lot of macroeconomic forces that are causing us to sell less cars or to have to lower price because affordability is becoming really challenging because of interest rates. You won't really see that from legacy automakers until maybe Q4 starting Q1. Because they have those dealership lots and because they've had the quote unquote luxury of going from basically no manufacturing capability from last year to full throttle manufacturing capability in a way in this year. So just something to look for. I'm not saying this is totally going to happen, but if it's something that Tesla's calling out, it would make sense that it would feel at first because they don't have a dealership network. Every car they sell goes directly to the customer within 16 days at a maximum. If you look at their inventory days on hand, it's about 16 days, whereas a typical car maker is 60 plus days. And then again, they're coming from no cars on a lot to a lot of cars on a lot. So it's going to take even more than 60 days to feel that pain, if you follow what I'm saying. So something to look out for there. The other negative too is I do feel like the call yesterday really... it dampened everything positive that's going on about the company. And one can talk about, okay, is that a sandbag? Is the company trying to sandbag expectations? Are they trying to lower expectations to surprise on the upside in the coming quarters? But I do think that there is a lot of legitimacy to the concerns that Elon and the team conveyed yesterday. They must have some sort of data that says, hey, there's pain ahead. There's maybe more pain ahead, and you should embrace for it. And this is in the middle of a Cybertruck ramp as well, Tesla's new truck that finally had a delivery date. And this is what I'm talking about. If you're a Tesla fan, this right here, how long have we been waiting for this? We finally have a date. November 30th, 2023, in about a month and a half from now. It's nuts, right? This is crazy. I can't believe this is a real poster, but it's real. This damn thing, this triangle on wheels, is finally coming to fruition in about a month and a half. It's official. It's no longer vaporware, as some were claiming. It's official. And the broader tone that I'm noticing from the broader markets and people following Tesla, and sort of as I go through my feelings, is like, boy, I wonder if I would have been more excited if this was like its standalone sort of a announcement versus it being paired with the tone of the call. But I think within that call, the tone of it, the thing that was surprising to me was the first time that I think I've ever heard Tesla say that they're not going to go as fast as they can, like balls to the wall. The usual mantra for the company is we're going to go as fast as we can because we're like, we are in a mission to accelerate the world's transition to sustainable energy. We have to get EVs on the road as much as we can because we need to offset the impact from fossil fuels, and we need to make sure we have a successful future from that perspective. We don't run into any risks, so on and so forth. If you're familiar with the company, you know their mission statement and all that good stuff. And it's always been like crazy drive to get there. And on this call, it was like, well, we should probably not go as fast as we can because there's uncertain macroeconomic things with the high interest rate environment, which makes cars less affordable. Oh, and by the way, there's a couple wars going on with Ukraine, Russia, and then the whole thing going down in Israel and Palestine. So that's a tone. That's something that I've never heard. And remind me in the comment section if I'm wrong on this. I don't think I've ever heard that before from the company where they're deciding to slow down because of what's going on, right? And in the past, they have quote unquote slowed down to go faster right after they slow down by retooling or implementing some additional sort of things to make him go faster. But in this call, what I heard was like, we're on purpose not going to go as fast as we think we can because we're uncertain about the broader global trends. That seems like a big deal to me. And I'm still processing what that means. And I would love to hear your comments in the comment section below. But where it would likely show up, if I were to guess, that's likely going to show up in the financials in the near to medium term, in lower pricing and lower margins and lower net income, if I were to guess. But I still feel like within the production capacity that Tesla has right now, it still means growth. It just doesn't mean as fast as one would have hoped based on some of the guidance that we may have heard earlier in, say, 2021 or 2020 even. The compound annual growth rate of 50%, for example, is going to be delayed, right? It may still happen. They may still hit 20 million by 2030, even though right now, today, that sounds absolutely insane to talk about. But if they're successful with the Gen 3 and there's a rebound in the economy and people are more accepting of EVs and interest rates go down, 7 years is a lot of time for exponential growth is what I'm trying to say. So the way I think about Tesla's near term to medium term growth, I think is much more focused around this chart right here versus thinking about, Tesla's going to say, hey, we're going to do about 30% or 40 or 50% compounded annual growth rate. Based on the guidance that we got on the call, let me go. Okay, that works, I guess. We're going the right. This chart right here outlines from the earnings deck what the capacity is for each one of the models, for each one of the factories. And this is the first time we've seen this, which again, how crazy is it that we have this number within the context of what we just listened to on the earnings call? We finally have a number for the production capacity for Cybertruck. And then we also have the capacity for a lot of these cars as well for each one of the factories. So if you add all these up, it's about 2.3 million car capacity that Tesla has built out right now across the factories. The one thing to keep in mind is that this number here is going to take a while to hit, and this was guided for on the call. Anytime there is a new product ramp with Tesla, Elon seems to get kind of depressed because production hell. He seems to really be scarred from Model 3 and Model S and Model X. Model Y, not so much. Model Y was by far the most, I think, the fastest ramping product that Tesla has had. But the overarching theme was this is going to be very, 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 very hard. And we're probably not going to get to the full ramp of 250,000 units per year until sometime in 2025. And so a lot of caution was put in the wind about this number. However, if you total this number up and you see sort of these greater than signs here, Model Y has been in Texas for a while, meaning like a year or so. Shanghai has been going buku for a long time. And so if you kind of add these numbers up, it's 2.3 million. And so if you compare it to this year's target of 1.8 million, which is likely going to happen, they'll need about 475,000 units. 475? Was it? How many units do they need in 2023 or the fourth quarter? I think it's 476. Yeah, so not that many. So it's very likely that they're going to hit that target. And so it's a 30% growth rate into next year. 30% growth rate for an automaker is still kind of insane if you really think about it, outside of a startup like a Rivian or hopefully Lucid, which is not doing so well, unfortunately. But if you're comparing it to the rest of the auto market, a 30% growth year over year within this context is still amazing because you're still adding an additional 2.3 million cars to the entire fleet next year, which at some point down the future will have full self-driving capability, which if you follow the company closely, this is really the holy grail of Tesla's profitability long-term. So yeah, so I just wanted to put that within context. And another thing I want to highlight too from the call or from the earnings that is finally happening, but again, it was kind of lost in some of the tone of the call. Energy gross margin, y'all, has gone from 9.3% in Q3 of 2022 to 24.4% in Q3 of 2023. Tesla Energy is now Tesla's highest gross margin product in its entire portfolio, right? I don't have the breakout for Y and 3 and S and X, so I have everything sort of lumped into the car. But 24.4%, I don't think many people expected that gross margin. It's important to keep in mind, though, that it's on revenue that is still quite small. You know, in the third quarter, they did about $1.6 billion of revenue. So a 24% profit on $1.6 billion is like $400 million, $400 million. Is not a huge number. It's not like the car number that is potentially in the $5 billion figure if they're able to sell it at a high profit, right? It's still small. But this is the one where this one's like sneaky. This one's sneaky. But I don't think it's going to have the same impact as the car market will, at least in the near term, because it's not sexy. You know, it's not a sexy thing. I think that a lot of people haven't gotten their head around what this means yet. It's kind of like oh, wow, look at this. Tesla's making $400 million a quarter on this line item. That's cool. I don't know what to do with it. That's kind of the vibe I'm getting from the broader base. So yeah. Overall, I'm gonna do some questions here for a little bit. Overall, the tone of the call was definitely, I think folks should pay attention closely to the warning signs that are out there. If I'm looking at the broader macro trends, if I just look at the United States, at least, even though inflation is down quite a bit, which is a great trend, and even though people are still going out there and spending, which is good, the credit card debt is at an all-time high. If you look at it, I'm not going to say all-time high, the highest it's been in about a decade or so. Saving rates are down significantly versus pre-COVID levels. Default rates are going up for credit card rates. Default rates are going up for subprime car loans. We're seeing a lot of car inventory piling up for more expensive cars, specifically around pickup trucks, which is usually a sign that people can't afford higher ticket items because pickup trucks are more expensive. So there are signs in the economy that say, hey, things are breaking in places, but the broader trends, it's kind of like if you go outside and you go to the mall, you still see people, right? So anecdotally, it doesn't feel like something's breaking, but when you look at the numbers, something's happening. And it maybe the company's trajectory from this point forward is to be overly cautious on navigating that environment until they have a clear signal that says, okay, this looks like something we can really push towards, instead of trying to be overly, say, pessimistic, and then we'll switch gears and maybe do something about it. Who knows? Another positive I wanted to highlight here before we go to Q&A. And this is a very underrated thing about the company, in my opinion. I would love to hear the other side of this. The cash balance for the company has gone from $21 billion to $26 billion, while revenues have stayed relatively flat, and net income, the profitability of the company year over year has gone down by about 50%. So Tesla's making less than 50% of what it was doing every quarter about a year ago, yet they were still able to raise their cash balance through cash flows, through selling stuff, and through some investments by more than $5 billion. And their debt, their long-term debt, which is this number here and this number here, is about $10 billion, which, if you compare it to the rest of the auto market, is by far the best positioned company from a balance sheet perspective out of anybody, by far. $26 billion of cash in the bank, which, by the way, they can get interest on at 5, 6, 7% potentially. And then the long-term debt is about a third of their cash balance versus if you look at every other automaker, their long-term debt is usually multiples multiples of their cash balance. They might have 30, $20 billion of cash, but they may have 70, $80 billion of long-term debt, right? So it's like flipped. They have more cash than they have debt. From a financial perspective, it seems like this company is positioning itself to be like, okay, we're going to ride out whatever wave comes our way, which could be, again, another signal that says, yo, there might be something happening. But yeah, those are my thoughts. Let me know what you think in the comment section below. Type question before your question so it's easy for me to pull it up. Cybertruck's coming. The stock is down 10%. There you go. I should just started with that. Cybertruck's coming, stock's down 10%. Yay. Fantastic. Okay. Let's see. We got producer wife in the house. Awesome. Thank you, producer wife, for stopping in. Love you, baby. Let's see. Walmart has said that the consumer have changed what they're shopping for in their stores. People are buying more staples and basics. Yeah, interesting stuff. If you're interested in the broader sort of like Tesla stock story, it's always helpful to look at things like Walmart, Home Depot, Costco, McDonald's, because they kind of have signals on they can tell you if something's happening in the broader economy. You know, like when people start buying things that are cheaper, that typically means that people are starting to feel the pain, right? And they're not able to afford as much as they used to. So that's why looking at things like Walmart might be smart. So let's see, Corey, when are Gary and Alexandra back on the channel? I love your catch-ups. Oh, thanks, man. So Alexandra was just on yesterday, and then Gary will get on at some point in the near future. I appreciate the question there. Let's see. I'm now waiting for 2025 rather than 2024. Sad news. Yeah, I'm not sure what you're waiting for, but I'm guessing the overall thought process here is that because of the guidance that Tesla gave on the call, the sentiment is, hey, whatever I thought was going to happen next year is going to happen the following year. Or maybe they're talking about deliveries of Cybertruck or something. So, yeah. Let's see. The car manufacturers' dealers are painted into a corner. Something must break. Yeah, I mean, I think the interesting thing about the car market dynamic is the dealership network is truly a really good safety valve for manufacturers, if you really think about it, because you have God knows how much square footage of floor space where you can put production into, and it can just sit there indefinitely, theoretically, right? Until dealers throw a fit and something breaks, right? It's going to be very interesting to watch this play out. The litmus test for me against the guidance that Elon's giving on the calls is going to be tracking legacy automakers and legacy automaker dealers and their lots, and seeing if the overall trend of the auto market is continuing towards what Elon is guiding for, which is interest rates are crushing our ability to sell a car at the previous pricing levels because it's becoming less and less affordable for people to be able to buy a car. And we should see that everywhere, not just at Tesla. Early signs point to this happening already. But again, the fourth and first quarter, the guidance from those automakers, especially as they're, some of them are dealing with the UAW strike with Ford and GM and Stellantis, it's going to be very interesting to hear. We're already getting some signals out of places like Europe and out here where their EV cars, in some cases, are not performing nearly as well as they would have hoped. And so that's one thing that is also curious about this whole thing, even though players like Hyundai and Kia are doing great in a way, but players like Ford and GM are not. They're really, really not. And specifically around Ford, they just had a recall of the Mach-E, I think 2020 and 2021 models, where they had to recall it due to battery issues. That sucks. And I hope it doesn't impact their sales, because this last quarter Mach-E sales were really good to the dealers. So hopefully that's not an issue. So we'll see. We'll see what happens. Farzad, how do you plan on attacking the future outlook on Tesla as an investor? Yeah, good question. I think for me, I'm just a hold dude. I have confidence that the full self-driving suite and the bot will come to fruition. I'm very confident that the Cybertruck is going to perform ridiculously well. If you think about Tesla's 250,000 production target per year, starting somewhere around 2025, that would have already, like if they hit that by 2025, they would have already sold more than Rivian and the F-150 Lightning. And they would have been about a third to a fourth of the way to how many F-Series trucks Ford sells per year in the first 2 years of production of the truck, right? But really the big potential for the company truly is maximizing the number of cars, in my opinion, at any price. This is going to be controversial, at any price to the market, so that when full self-driving is ready, you flip the switch and you maximize the chance of somebody buying your software suite at 100% margin, essentially. And that makes the car have margins that are much more similar to a software product over the life of the vehicle than a traditional car. But that requires confidence that full self-driving will come to fruition. And as somebody who's had the software in my car for the last couple of years, and I see how much it's improved to the point where I rarely drive anymore, like physically actually drive, and I just let the car do it, I can't help but be very confident that that's going to come to fruition because I live it every day, right? And I put it through its paces, and I follow that technology very closely. And I compare it to the competitors where I think like Waymo and Cruise and all these guys don't have, even though the technology is incredible, and I'm glad they exist, the scale, the scale, the amount of effort and cost is going to take to scale a Waymo or a Cruise to be in every city and every road on the world seems so much more challenging than the way Tesla is approaching it. And since Tesla is investing heavily on their AI division, which is something they highlighted on the call, which again is missed because of the sentiment of what was said around short-term and medium-term trends, that is what's going to enable Tesla to take it to the next level. And then we're not even talking about the bot using that same exact foundation to do its thing. So for somebody like me, that's what I look for, right? I'm extremely fortunate, and this doesn't apply to everybody. I'm extremely fortunate where I don't have to worry about that number that's sitting in my investment account doing anything anytime soon at all. It's there because I think in the future, it's going to be such a ridiculous value to have a self-driving car and a humanoid robot that can do your laundry for you, that whatever the price is today doesn't matter, right? That's the way I think about it. But because I'm familiar with the company and because I'm familiar with the trends and because I've been invested in it since 2012 and because I study the car market out of obsession because I'm a freaking nerd and I have a problem, I feel like it's of some value to people for me to come on and talk about these trends even though you may disagree, right? So that's just to give you a little bit of context into how I'm thinking about Tesla and why I do this in the first place, right? So, yeah. Thank you for the question. I appreciate you. Tony, I have always thought that as the man for NMC, LR, remind me what NMC is, I'm blanking on that. Long range 3Y EBs, those packs will go into the semis instead. Given that macro is likely eroding demand for long range 3 and Ys, do you expect semi to ramp in 2024? Yeah, I mean, I think semi ramps regardless of 3 and Y. I think the volume of semi, that's a great point, right? Because if there truly is, and this just sort of highlights the flexibility of Tesla, if for whatever reason in 2024, 3 and Y, which are Tesla's by far highest volume producers, are impacted and they're stuck with a glut, quote unquote, of batteries, guess where they can put these batteries? Especially if they're 4680s. Cybertruck, semi, potentially. Energy storage, right? There is a product that Tesla can put batteries in that they can sell at a profit, which will put cash into their bank account across multiple modes, right? And it's a luxury for the company to have that. If you look at any other company, like a traditional automaker, especially if they're trying to get into EVs, the battery is the battery. Either if they're using the Ultium platform or if they're using, batteries from LG or whatever, they're kind of stuck with that because they're not vertically integrated. They're just a collector of separate pieces that happen to make a car when they're finished, right? So, but I don't think that's the right lens to look at it. I think I think 3 and Y will still be successful. I think they'll still maximize the current capacity for those two cars. And I think they'll ramp Semi as they ramp Cybertruck. So, and if there's surplus batteries, great. That means they can make more semis, but I don't think they're going to be able to make that much more semis. But I think that they're much better suited in, people are going to hate this, lowering the price of the 3 and Y and getting more on the road so that when you flip the switch for FSD, instead of having 1,000 more semis on the road where you maybe can't even turn FSD yet, you could do 20,000 3 and Ys on the road where you could totally turn on FSD. And that FSD is going to be nuts, right? So, in my opinion, Jordan Gissigi, I love you, man. Shout out The Limiting Factor. Make sure you go check him out. Fantastic channel. He does so much great work. We love you, Jordan. You are the man. Thanks, baby. You guys are awesome. Let's do a couple more. I'm gonna do a little bit extended today because I know, I did a couple polls on X, and I know folks are a little down from yesterday if you're following the Tesla story. So yeah, it's I get it. Okay. Estimated semi volume for 24, 25, 26. Yeah. Again, it's gonna be low. I'm not even modeling these, to be honest, because I'm much more. I think Cybertruck and energy as a business will have a lot more impact than the Semi will, as I'm thinking about it. I could be wrong. So I don't even have a good answer for this one. But I think in the long term, I wouldn't be surprised the Semi is at somewhere around 50,000 units annually, or somewhere between 30 and 50,000 units annually, say by the end of the decade at some point. Who knows? Okay. Let's see. Johnny, I am the same with you. Ridiculous long-term holder. We are both ridiculous. I agree. Nice picture, by the way. It's an Audi R8, I think. My only question from yesterday is why delay Mexico? 25,000 cars needed ASAP. Will it be produced in some serious mass in Tejas? Do you believe? Yes. So in the book, in the biography of Elon Musk by Walter Isaacson, it was revealed that the compact car will start production in Texas. So they can still very much get that Gen 3 platform out within the next couple years out of the Texas facility. But the delaying Mexico question is directly correlated to the lack of confidence in the broader macroeconomic environment and delaying that. But it doesn't mean that the car won't come. Right? It won't come in mass, maybe. You won't have two factories making those cars. You'll have one. And there's an open question do they have enough capacity at Texas to match the capacity they had in Mexico? And from an acreage perspective, the amount of land they have in Austin for that factory, theoretically, they could put up a Giga Mexico in Texas if they really wanted to. But the question becomes, how much production, what is the gap in production between Texas and Mexico if they chose to do that? But who knows? I think the $25,000 car comes anyway, but it'll come out of Texas first. And then once they're ready to go into the next gear, they'll kick up the second one. But the broader question though, and I think this is really interesting, right? And this is a legitimate question I have for Tesla. If price was so important, why isn't Mexico going up immediately, right? Why isn't the Mexico plant, which has the $25,000 car, if price is really affordability is really that important, why not do that now? I feel like that should be a giant priority for the company. So if Elon sees this, let me know if maybe I'm thinking about this incorrectly, or I'd love to hear your thoughts in the comment section below. But that's the one where I'm a little bit okay, but if that was the case, then you would want to throw that up immediately. The alternative could be is that, hey, maybe they are doing that in Texas already. Maybe Texas will be that thing where we are going to throw up the $25,000 car as soon as we can. And that's what we're doing in Texas. We're not going to wait for permitting and stuff in Mexico. You want to call it Mexico, but Mexico, it's the same thing. So yeah, it's a great question. It's a phenomenal question. I think it's a legitimate question around if you want to poke a hole into the whole, hey, pricing is an issue thing. Okay, but then why aren't you building the $25,000 car faster? So it's a legit question. Thank you. All right, let's see. When do you see Chinese EVs coming to the US? Yeah, this one's an interesting one because there's a lot of tensions between the US and China, and there's a potential conflict with Taiwan in the later decade that's starting to arise. It's all dependent on how relationships go with the two countries. I think at some point they'll make it over. I think maybe by the end of the decade we'll start seeing a lot more Chinese EVs coming to the US. And if they make a good enough car at a low enough price, I think they'll be very successful, to be honest. And the companies that should be most concerned about this is legacy automakers, for sure. I think Tesla and Chinese EV manufacturers are going to do extremely well this decade. I think Rivian will do extremely well this decade as well. And it will come at the expense of legacy automakers. So I would monitor the relationships between the US and China and see if there is any signal there. They already sell in Europe, and they're kind of they're not super successful there. But at some point they'll make it over. There's going to be too big of a gap in auto for them not to come over. It's like Sandy Monroe has talked about this a lot in the past. It's reminiscent to the Japanese takeover of the US market back in the 70s and 80s and 90s, where there was a gap in affordable, reliable cars in the market. And the Japanese are like, okay, I guess we're going to start selling them here then. And then the US automakers were like, nah, no one's going to buy that crap. And then lo and behold, Toyota Corolla, Honda Accord, Nissan Altima, and all the different variations, or Datsun, or whatever it was called back in the day. Mitsubishi, all these brands started just dominating everything. So similar dynamic with Chinese and US brands. So yeah. James, huge supporter of this channel. Thank you, brother. Am I the only follower that wants to bring back the riff? We'll bring back the riff at some point, my friend. We'll play these soon, I promise. Maybe I'll do a video. Am I working on one? I don't know. I thought the delay on Mexico was lack of water and electrical infrastructure. Yeah. So some of the reporting was on that it was more of a permitting issue. It was like a Berlin thing going on. But from the call, yesterday's call, again, correct me if I'm wrong in the comment section, what I heard was we're going to slow down because we're not confident about the macroeconomic environment. And so we're going to let Mexico kind of hang out until we get there, until we're confident about it. So I think it's maybe both. Maybe it's like a permitting thing. They're like, you know what? Let's not try to push this too hard. We'll kind of let it play along. Let's see what's going on. Let's start our construction in US for Gen 3, and then we'll go from there. But yeah, correct me if I'm wrong in the comment section below. How do I raise funds for my startup? Please give me tips. I am the last person you want to ask, bro. I'm terrible at asking for that stuff. I just figure out how to do it on my own all the time, which sometimes is a bad idea because then you start freaking stressing yourself out for no reason. But I'm the last person you want to ask. In what year will another American automaker sell as many BEVs as Tesla did in 2020? Ooh. Let's see. So Tesla did 500,000 units in 2020. American battery electric vehicle makers are Ford, GM, Stellantis, Rivian, Lucid. I don't think GM will hit that at any point, unfortunately. I think Ford has a chance, but it's looking bleaker and bleaker as they keep hitting walls. Stellantis, I don't think we'll get anywhere near that number. I would say Rivian will be the first one. Okay, this is a prediction now. All right, here we go. Somebody write this down and tell me when I'm wrong. I'm going to say Rivian's going to hit 500,000 units per year by 2027. Book it. Not financial advice. Total guess, like literally total guess. I'm just making stuff up now. And a lot of people will say, like usual. Hilarious. What do you think of Tesla's 14 billion in accounts payable? It's just accounting, normal. I'm not too concerned about the receivable or the payable. I'm much more focused on the cash balance for the company. I think Tesla doesn't get enough credit for being an extremely well-run from a financial perspective. I mean, their balance sheet, if you compare their balance sheet versus every other large-scale automaker, and you look at their debts versus their cash and their assets versus their liabilities, I mean, you'd be like salivating. You'd be like, how is this? Like, it's no wonder that their multiple is so much higher than every other automaker. Like, it makes sense. Look at the balance sheet and compare it. It's so obvious, you know? Yeah. Okay. I think we call it there. We've been going for about 45 minutes. You're very welcome, Gino. Thank you for your support. I hope you have a great rest of your day. I might go live again tomorrow, and we'll see. But if you saw this in recording, thank you so much. Like and subscribe if you like what you saw and you want to see more from me. And if you're live, thank you for joining me. Thank you, mods, as always. Love you guys very much. And we'll see you on the next one. Mwah. Take it easy. We'll do a little outro here. Bye-bye.